Something happened in China recently that I don't think has received anywhere near enough attention that it deserves. For the first time in history, the largest fund that ordinary Chinese citizens invest their money into is not a stock fund, it's a gold ETF, China's equivalent of the S&P 500. The fund that has dominated retail investment in the world's second largest economy for years has just been overtaken by a gold fund holding 13 billion in assets. Now let that sink in for a moment. In a country of 1.4 billion people, the single biggest pool of retail investment money has just moved into gold. I'm Nicholas Ward from Gold Bullion Partners, and in the next 10 minutes I want to explain why this isn't just a fascinating data point, it's a signal about where the entire global monetary system is heading. And once you understand the logic behind it, the gold price, the central bank buying, and even some of the more the outlandish price predictions you may have seen start to make a great deal more sense. Now, let's start with what China is actually doing, because the retail fund story is really just the surface. The People's Bank of China has now bought gold for 20 consecutive months. The longest unbroken buying streak on record going back to at least 2015. In a single recent month, they purchased gold to 15 tons. It was close to 15 tons. And that's the largest monthly acquisition we've seen in nearly 3 years. In the last 5 months of this year alone, China has imported roughly 700 tons of physical gold. And since 2015, that cumulative total imported amount into the country stands at about 14,000 tons. This isn't a trade. This is not momentum buying. This is a nation systematically converting paper wealth into physical metal over a period of years at a pace that is accelerating even as the gold price corrected sharply. Now, the People's Bank of China was buying more gold as the price fell 30% from its highs. And that is not the behavior of an institution trying to make money on a position. That is an institution accumulating an asset it believes will underpin a future monetary system. And it isn't alone either. World central banks as a group have purchased over 1,000 tons of gold per year for 4 consecutive years too, double the pace of the previous decade. Poland, Kazakhstan, Uzbekistan, countries across emerging markets are adding to reserves consistently. And here is what is actually telling: almost nobody is selling. So the question worth asking is not whether this buying is happening. It clearly is. We all know that. It's clear to see. The question is why. What does China know or believe about the future of the global financial system that is driving this level of accumulation? And to answer that, we have to go back further than most people expect. In the aftermath of the 2008 financial crisis, China was sitting on trillions of dollars of US Treasury bonds, effectively its national savings account, watching the Federal Reserve print money at an unprecedented scale to contain a crisis of American making. The governor of China's central bank published an official paper the following year making a pointed argument. The world's reserve system should not be stored in any single country's currency. What was needed, well, he argued, was a neutral international reserve asset, something no single nation could really control, something that could remain stable over the very long term. And that argument went largely unheard at the time, but China didn't stop making it. They consistently making the same point. And more importantly, it didn't actually stop acting on it either. They're putting their money where their mouth is, quite literally. Now, fast forward to today, Scott Bessant, the US Treasury Secretary, recently published a piece in the Wall Street Journal laying out the economic framework guiding the current administration, a return of what he called Hamiltonian economics. And the core idea to that is very straightforward. A nation that cannot manufacture the things it needs is not truly sovereign. And America spent 50 years almost hollowing out its industrial base in pursuit of cheap imports and financialized returns. And the plan now, of course, is to actually go back and rebuild it. But here's the very problem with that. And this is really the part, I suppose, that connects everything. You cannot simultaneously rebuild American industry, protect ordinary workers from rising prices, and maintain a strong dollar. Those three things are in direct conflict with each other. A strong dollar is precisely what makes American manufacturing uncompetitive against cheaper imports. You can only pick two of them. And according to serious economists who studied this pretty closely, the one Besant is most likely to sacrifice is the strong dollar. And that's not through some dramatic announcement, but gradually and steadily over time, using another asset as an escape valve, a neutral reserve asset, something that can absorb the dollar's adjustment without the whole system coming apart altogether. Now, there is only one asset with the history, the global acceptance, and the fixed supply to play that role, which is why China's behaviour since 2009 suddenly looks less like speculation and more like preparation. China has been building towards a gold-anchored reserve system now for the better part of 2 decades. The retail gold funds surpassing the stock fund, the central bank buying through a 30% price correction, and perhaps, I suppose most tellingly, 4 of China's biggest banks have recently moved to shut down retail paper gold trading. And of course, directing their citizens to actually purchasing the physical metal only, coins, bars. ETFs with bullion sitting in an actual vault, although there is speculation as to whether that does too. And if you believe gold was going to become the neutral reserve asset of a rebalanced global trading system, the last thing you would want is a vast superstructure of paper claims and leveraged futures contracts sitting on top of real metal. You want your citizens to actually hold the physical thing, and that's of course exactly what China's doing, and none of us in the West, of course, are following suit. Now, I also want to address here the price figures you may have seen circulating at the moment, because some of them are striking enough to seem a bit absurd on first reading. You might have seen the $38,000 an ounce figure come from a specific calculation at the moment. Take China's annual trade surplus, divide it by gold imports, and you arrive at the price at which China could theoretically settle that surplus in gold rather than dollars, basically. So it's not a prediction, it's a mathematical expression of an imbalance that exists in the current system and what it would take to resolve that imbalance. So does that mean gold goes to $38,000 next year? No, it doesn't. These structural shifts play out over decades, not months, but it does tell you something important about the direction of travel, and it helps explain why central banks are buying at a record pace through price corrections that would have retail investors heading for the exit. They're not trading gold, they are positioning for a different world, a new world, a globally economic order. And here's the uncomfortable truth: at the heart of all of this, there are really only 2 ways that transition plays out. In the first scenario, the reindustrialization effort fails. Debt continues to compound, confidence in the paper system eventually breaks, and the adjustment happens in a rather disorderly way. very sharply, very painfully, with gold rising not because of a plan, but because of panic. And in the second scenario, the major economies manage a controlled transition. The dollar gradually cedes ground over time. Gold plays an increasingly formal role as a neutral reserve asset, and the global trading system rebalances over time without a crisis. That's the preferred path, of course. But either way, the destination is the same. The only variable is how turbulent, I suppose, the journey is actually going to be. And what I take from all of this as a gold dealer is pretty straightforward. The buying we are seeing from central banks and from China specifically is not driven by a view on the gold price at all. It's driven by a view on the monetary system. These institutions are not asking whether gold is cheap or expensive at current levels. It's irrelevant to them. They're asking whether they want to be holding paper claims on a system that is under structural pressure, basically, or whether they want to be holding the one asset that has maintained its role as a store of value through every major monetary transition we've seen in history. And that is the question every investor should be asking themselves right now. Not what is the gold price going to do next month? Is it going to go down 1%? Is it going to go up 5%? But what is my exposure to a system that the world's most powerful economies are quietly, methodically building an alternative to? I'm Nicholas Ward. If you want to discuss what physical gold ownership looks like in practice, the link is below. Book a call with myself or a member of the team. We'll more than happily take you through everything that you want to know, and look forward to hopefully speaking to some of you soon. Take care.